Just in, today's payroll data comes in much lower than expected, sending markets crashing. Is the labor market finally starting to crack? So we got non-farm payrolls data today. This is out by the BLS, the Bureau of Labor and Statistics. We can see big moves in the equity market. Equities are down about 1.7% last I checked. Big move in bonds as well. The 2 years down 21 basis points in a single day. We have the 10-year down about 13 basis points, and we have the 30-year down slightly less at 9 basis points. If you were to look today alone, that would be what's called a bull steepening. This is what generally happens when the bond market is expecting rate cuts. And if you get a very weak number, the bond market will start to price in Fed cuts. That's kind of what we're seeing today in the bond market. Here's that NFP print. We see that the expectation was 110,000. We came in at 73,000. Now it's actually much worse than this. And I think what's really moving the markets is the revisions. This was a very common theme under the last administration to see massive revisions. Like 1 year, we had 1 million jobs revised down. And so it was a common theme back then. Didn't seem to matter to the markets much. Maybe it's finally starting to matter. We had May's number revised from 144,000 down to just 19,000. We had June's number revised from 147,000 down to just 14,000. Just in those 2 months alone, you had a revision of 258,000 jobs. Now, I also want to show the average hours worked. We'll go into the actual report, but we can see that the average hours worked still remains somewhat low at 34.3. This is in the context of very low initial claims that we looked at yesterday, low continuing claims as well, although continuing claims have bottomed back 3 years ago, and they've been heading higher ever since. Now, normally when continuing claims bottom and they start moving higher, normally, if we just look back at history, they eventually experience a parabolic rise upward. And that is either at the start of a recession, the red shaded areas here, or right before the recession actually starts. So, maybe this time is different where a continuing claims heads higher and doesn't ever have that exponential rise. But history would tell us that generally speaking, with a softening labor market, especially softening to this degree, we were very close to having 2 months of negative NFP prints due to the revisions I'm referring to. So, it is quite possible that we see that kind of, a large increase in continuing claims and the unemployment rate. Unemployment rate remains very low compared to historical averages here at 4.1%. You can see going back, that is very low compared to historical averages, but it's not the best way to measure unemployment. So U6 is a more broad way to measure unemployment, and we'll look at the components in the report that we're going to look at. But U6 unemployment rate is nearly double the headline unemployment rate that you will hear reported on the nightly news. So here's the actual release from the BLS. There's a couple important points that I think we should go through. Here we see the unemployment rate. It has been kind of grinding higher. Here is the NFP. These are jobs added. And again, look at how close we were to two consecutive negative quarters in job growth. So again, we'll need to pay extra close attention to the labor market. Also, I think what's interesting is there's a bunch of nuance with the labor market. For example, what sectors are the jobs in? Here we see that employment in healthcare and social assistance sectors are trending up and contributing to a large component of the overall job gains. Well, is it a sign of strength in the economy if we're having to hire a bunch of people in social assistance? Federal government continues to lose jobs. That is kind of the Doge story. They talk about the unemployment rate. Unemployed people stand at about 7.2 million. Here, I think, is what's interesting. So among the unemployed, the number of new entrants increased by 275,000 in July. Now currently at 985,000. So almost 1 million new entrants. These are unemployed people who are looking for their first job. We know recently that data came out that those graduating with a college degree their unemployment rate is just as high as those who never went to college. So this is really important. Again, a kind of nuance to some of this labor market data. Long-term unemployed, another good kind of piece of nuance. If you're unemployed for say 2 or 3 weeks, but you're able to find a job after a couple weeks and you get back employed, that's really not that big of a deal. But if you're staying unemployed for 27 weeks, that's an indication of a much tighter labor market. Well, this increased by 179,000, now stands at 1.8 million. Long-term unemployed account for 25% of all unemployed people. Labor force participation rate, stay posted. Later on in the video, I have a very good chart to show for that. And then part-time for economic reasons. We were talking about U6 versus that headline unemployment rate. Well, one of the things the headline doesn't count is part-time for economic reasons. This changed very little, but stands at 4.7 million. That's a large number of people. This is people who would have preferred full-time employment, but were working part-time because their hours had been reduced or they were unable to find full-time jobs. Again, just because a job is created doesn't necessarily mean that it's a great labor market, great economy, right? If a bunch of jobs are created, but they're all part-time. This was a common theme under the last administration, actually. Is that really a sign of strong economic conditions? If you're creating a bunch of jobs, but they're in low-paying sectors or something like social assistance, is that a sign of a strong labor market? Probably not so much. So, and then finally, number of people who are not in the labor force, but they want a job changed very little month over month, but was up 568,000 over the year. These are people who are not counted as unemployed because they are not actively looking for work during the time that the survey is conducted. Also, as well, among those in the labor force who wanted a job, the number of people marginally attached to the labor force, again, another thing that the headline unemployment rate does not count, but U6 does count, this marginally attached. This changed little month over month. These are individuals who wanted and were available for work and had looked for a job sometime in the prior 12 months, but had not looked for work in the past 4 weeks. And then, of course, discouraged workers is a subcomponent of that. That actually decreased by 212,000. But this currently stands marginally attached to the labor force, currently stands at 1.7 million. So, you take that and you add it to the number of people part-time for economic reasons, you're talking about, 5 million plus people. And of course, healthcare continues to add jobs, one of the strongest sector for job gains. Depends, greatly on the pay. There are a bunch of very, very, very low paying jobs in healthcare. And of course, social assistance continues to grow. This has been the story for at least the past couple months. We've been doing these labor market recaps. Federal government continues to shrink, as we have also been covering. So here I want to show that tick up that is really, really interesting. So here, I will link to this in the description, but here are those new entrants. And we went from in May, 725 up to, I think this is in thousands. Yeah, 725,000 in May up to 985,000 in July. That is interesting. And I think that is worth considering. I think that the other thing that was kind of caught my eye was the unemployment rate for youth. So here, of course, in red, we have that headline unemployment rate, the U3 unemployment rate, that headline rate. But look at the rate for young people is at 15%. So significantly higher from, now it always runs higher. This is normal, but 15%, that's starting to get up to levels that would possibly start to worry the politicians and those in power, because generally when young people are unemployed, it is not good politically. So here is that chart that I was talking about. It goes into my kind of whole silent depression framework. We have the labor force participation rate. We have real personal income. So this is the real purchasing power after inflation of your personal income. And then the S&P 500 divided by gold. So one way to measure currency debasement, again, over many years, many decades, gold is an excellent way of measuring currency debasement. Over an hour or a day or a week or a month, it's not, but over many years and certainly decades, it is. we can see they all peaked in the early 2000s. S&P in gold terms peaked in January of 2000. Here, real purchasing power of personal income peaked in April of 98, and the labor force participation rate right before China was admitted into the World Trade Organization, this peaked in January of 2000. Ever since, all three of them have been down and to the right. So I again going into the silent depression framework, I think that things are much worse in reality once you start peeling back layers of the onion. So here's inflation rate. This is headline CPI because most people need that food and energy that gets stripped out in the core CPI metric. So I'm using headline CPI. And then I put on average hourly earnings growth on a year over year basis in red. And what we can see is that going back to April, May of 2023, average hourly earning growth has been running above headline CPI. Now, this is good. This means that inflation adjusted, people are getting real wage gains. Well, the problem is that headline CPI or PCE or PPI do not accurately measure inflation. Talk to anyone, any normal average American, and ask them if things have only gone up 21 or 22% over the past 5 years. They will laugh in your face. It is nowhere near the actual inflation rate. Now, for example, going back to this particular metric here in red, it should be noted that the money supply, remember, inflation is a monetary phenomenon. The money supply grows on average by 8% per year. So if we were talking 8% per year, if we move the yellow line up to just the rate of currency debasement or monetary expansion here at 8%, now the earnings growth might not look so strong. Now you are negative by about 4% per year. You are getting 4% poorer per year. Now, a lot of that money supply goes into assets. So if you already own a home, you already own stocks, you might actually kind of net benefit. If you are a young person, however, who does not own a home, which is just leveraged exposure to currency debasement, that's all home wealth is. If you don't own a home and you don't own $1 million of S&P 500 stocks, this is brutal for you. And so it's important to point out there are many different ways of measuring inflation. Consumer price index is just one of them. Finally, to end, here's the yield curve. I mentioned today in isolation, we are seeing a bull steepening. The 1 year's down sharply, the 2 years down sharply, 30 years down, 30-year yield is down, but it's not down nearly as much. This is called a bull steepening. The gap between long-term rates and short-term rates is growing tighter. Excuse me, wider. The curve is steepening. The gap is growing wider, but the reason it's growing wider is because short-term rates are falling much faster than long-term rates. So steepening can occur either all rates are rising, but long-term rates are rising faster, so the gap grows, or in a bull steepening, short-term all rates are falling like we're seeing today, but those short-term rates like the 1 year and the 2 year, those are falling much more sharply and therefore increasing the gap. So remember, the yield is inverse to the value of the bond. So here, for example, we could see, that the price for those short-term bonds. Now, of course, there's convexity issues, and it's not always a one-to-one. But a bull steepening is generally seen before a rate-cutting cycle, where the short end rallies more significantly, expecting Fed rate cuts. And I'll go back to following 2008. We can see that that is what happened. All rates were down, right? Here's in white, the federal funds rate that the Fed controls, that overnight rate. And all rates are coming down, but short-term rates came down way quicker, especially here kind of in the summer, into the summer of 2008. We can see those short-term rates, yellow and orange, and red, these are coming down much faster than short-term rates. All rates are coming down, but the gap is widening because short-term rates are falling much faster than than long-term rates. So that is what we're seeing at least today. That would indicate, the cutting cycle that we are in. But again, I think it's important to note the larger context, which is we are in a rate cutting cycle. I think it's undeniable at this point, especially with this payrolls data. But since the cutting cycle began, we have still seen a bear steepening. So the larger framework is a bear steepening in bonds. And only today in isolation are we seeing that bull steepening. So that is something I think we're going to watch over the next couple months to see, if we go back to more of that bear steepening dynamic, or if we really get bond yields down in a meaningful way, expecting significant rate cuts. We know that yesterday two different governors dissented. This is very uncommon, and they cited the labor market, which is sure enough, we got the labor market data today, and it was quite weak. Anyways, a lot of things to watch for the rest of the day. Equities appear to be getting a bit of a bounce here. VIX is coming down a little bit. Bond yields remain little changed. Of course, the dollar is pulling back. It's had that squeeze that we kind of forecast here back about a week ago. That is starting to give back some of the dollar's gains on expectations, of course, of Fed rate cuts. Generally, when you get into Fed rate cuts, that is generally weak for your currency. So, anyways, hopefully covered everything, and I will link the BLS report in the description, and I will catch you in the next one.